The most powerful force in the global economy is a number that can change on a Wednesday afternoon. No election, no invasion, no breakthrough technology, just a number. Sometimes it moves by 0.25%, and when it does, trillions of dollars quietly shift direction. Mortgage payments jump, stock markets flinch, currencies stumble, jobs disappear without an announcement. Most people never see it happen. They just feel it months later and wonder why life suddenly costs more. We're told this number controls the economy, that if you raise it, inflation dies. If you lower it, growth returns. A simple lever, up or down. That story is comforting. It's also not really true. Because if one interest rate actually controlled everything, recessions wouldn't catch policymakers off guard, housing bubbles wouldn't keep inflating, and central bankers wouldn't sound so uncertain while reading carefully scripted statements. So why does the entire world still freeze when this rate moves? And why does it matter so much right now? Over the last few years, interest rates moved faster than at almost any point in modern history. For more than a decade, they sat near zero. Money was cheap, borrowing felt harmless, debt felt invisible. Then inflation arrived, quiet at first, then obvious, then embarrassing. And suddenly the rates snapped upward, the fastest tightening in decades. Markets didn't adjust smoothly, they jolted. Tech stocks collapsed, banks wobbled, housing stalled almost overnight. And every time the rate changed, headlines screamed the same thing. The Fed is tightening, the Fed is loosening, the Fed is in control. But here's the uncomfortable part. The central bank does not control most interest rates. It doesn't set mortgage rates. It doesn't set car loans. It doesn't set credit card APRs. It sets one rate, a very short-term rate, the cost for banks to lend money to each other overnight. That's it. So how does that tiny technical number end up shaping the entire economy? Through belief. Banks assume tomorrow's money will be more expensive. Investors assume future returns will shrink. Companies assume borrowing later will hurt more than borrowing now. So they react early. They cancel projects. They sell assets. They freeze hiring. The rate doesn't force these decisions. The expectation does. This is where the system starts to feel less mechanical and more psychological. The central bank isn't turning a steering wheel. It's flashing a signal and hoping everyone swerves in the same direction. Sometimes that works beautifully. Other times, it doesn't. Because modern economies aren't simple machines. They're networks. Money doesn't move in one clean channel from banks to businesses to consumers. It splinters. Corporations borrow globally. Governments lock in debt for decades. Investors chase yield wherever it hides. A rate hike might crush housing while barely touching corporate balance sheets. It might slow consumer spending while stock markets keep rising. Same policy, wildly different outcomes. And that leads to a dangerous assumption that if inflation stays high, the rate just isn't high enough. That if growth slows too much, the rate must be too high. As if the economy is a thermostat. Turn it up, turn it down. Wait, but that assumes the system responds evenly. It doesn't, because debt changes everything. The more debt an economy carries, the more sensitive it becomes to rates. Not gradually, suddenly. At low levels, rate hikes feel manageable. At high levels, they feel explosive. And today's global economy is sitting on more debt than ever before. Household debt, corporate debt, government debt, all built during years when money was almost free, which means the rate isn't just a tool anymore. It's a stress test. Every increase asks the same question: who can still afford this system and who can't? That's where the cracks begin to show. Not in headlines, not immediately, but quietly. In refinancing, in defaults, in layoffs blamed on efficiency. So if one interest rate really controlled the economy, this would be simple. It isn't, because the rate doesn't remove money from the system. It redistributes pressure inside it. And the higher the pressure, the less room there is for mistakes. That's the part most explanations leave out, and it's where this story turns uncomfortable. Because once you see what the rate actually does, you start to notice what it can't do at all. That's where we go next. Here's the illusion we're sold. Raise interest rates and inflation falls. Lower them and growth comes back. A clean cause and effect. But inflation isn't a single thing. It's a pileup. Energy shocks, supply chains, housing shortages, wage pressure, asset bubbles spilling into real prices. One rate is supposed to push against all of that at once, and it can't. What higher rates actually do is narrow behavior. They punish borrowing.
They reward waiting. They squeeze the weakest parts of the system first. And that's the key detail. Rates don't hit everyone equally. If you locked in a fixed mortgage years ago, a rate hike is almost theoretical. Your payment doesn't move. Your savings earn more. You might even feel safer. If you live on variable debt, credit cards, short-term loans, or rent in a market priced off new financing, the pain is immediate. Same policy, two different realities. This is where the hidden math shows up. Most modern inflation isn't driven by excess consumer demand. It's driven by structure. Too few houses, too much financial leverage, too much money chasing assets, not goods. Raising rates doesn't create homes. It doesn't fix ports. It doesn't make energy cheaper overnight. What it does is slow the parts of the economy that rely on constant refinancing, startups, speculative real estate, highly leveraged funds. That's why rate hikes often crash asset prices before they lower grocery bills, and sometimes inflation barely budges. So the central bank hikes again and again. Each time, the risks compound because the system is built on rollovers. Governments don't pay off debt, they refinance it. Corporations don't eliminate debt, they extend it. Banks don't sit on losses, they reprice them. Higher rates don't stop that process, they make it more fragile. Eventually, something snaps. Not everywhere, somewhere specific. A bank with mismatched assets, a fund using too much leverage, a housing market priced on permanently cheap money. And when it breaks, the story changes. Suddenly, the rate isn't fighting inflation anymore, it's threatening stability. This is the part policymakers never say out loud. There's a ceiling, not an official one, a political one, a financial one. Above a certain level, rates don't slow inflation faster, they just expose the damage already baked into the system. That's why central banks talk about lags. It's a way of saying we're flying blind. Rate hikes take months, sometimes years, to fully show their effects. By the time the damage appears, the decision that caused it is long past. So they rely on signals, markets, employment, credit spreads. But those signals are distorted by the same expectations the rate creates. Investors move before the data. Companies cut before demand falls. Consumers panic before prices adjust, which creates feedback loops. The rate moves, the markets react. The reaction becomes the justification for the next move, and all of it rests on credibility. Because the rate only works if people believe the central bank will stick with it. Once that belief cracks, everything speeds up. Inflation expectations unanchor, asset prices decouple, capital flees instead of waiting. That's the nightmare scenario. Not high inflation, not low growth, loss of coordination. And that's the irony. The interest rate is powerful, not because it controls money, but because it coordinates belief. And belief is unstable, especially in a system loaded with debt, leverage, and short-term incentives. So when people ask whether one rate really controls the economy, they're asking the wrong question. The real question is how long the economy will keep responding as if it does. Because the moment it doesn't, the number stops being a tool and becomes a risk. That's where the consequences get bigger than inflation charts or policy meetings. That's where the entire structure starts to wobble. And that's where this story ends. Zoom out far enough, and the picture gets uncomfortable. For decades, the global economy learned one habit. Whenever something broke, rates went down. Crash in 1987, rates down. Dot-com bust, rates down. Financial crisis, rates to zero. Pandemic, below zero, effectively. Every shock was met with cheaper money, not to fix the underlying problem, but to buy time. And it worked for a while. Growth returned, markets recovered, asset prices climbed higher than before. But each rescue left behind more debt, more leverage, more dependence on low rates. So now the system isn't just sensitive to interest rates, it's addicted to them. That's why this moment feels different. Inflation forced rates up, not slowly, not gently, fast enough to expose how much of the economy only functions when money is cheap. Zombie companies that survive only by refinancing. Governments rolling debt at higher and higher costs. Housing markets priced on monthly payments, not incomes. The rate didn't create these problems, it revealed them. And that's why the question, can one interest rate control the economy, misses the point. The rate isn't the engine, it's the stress lever. Pull it, and you find out what's real real and what was propped up by assumptions. This is where hype and reality split. The hype says central banks are all-powerful, that they can fine-tune growth, that inflation is a knob. Reality is messier. They influence behavior, they shape expectations, they slow or speed momentum, but they don't control structure. They can't fix inequality created by asset inflation. They can't rebuild supply chains with a policy meeting. They can't make debt painless once it's too large. And the more we rely on rates to solve everything, the less effective they become. Because every move now carries side effects. Raise rates and you risk financial stress. Cut them and you risk inflation returning. Pause too long and markets panic anyway. So what's left? This is the quiet truth no one likes to say. The interest rate is a signal in a system that needs structural change. And signals only work when the system underneath can respond. If productivity doesn't rise, rates won't fix stagnation. If housing supply doesn't grow, rates won't fix prices. If debt keeps compounding faster than income, rates won't restore balance. They just delay the reckoning. Which brings us to the unresolved question. If one number can no longer stabilize growth, inflation, and debt at the same time, what replaces it? More policy tools? More intervention? More debt to smooth over the next shock? Or a system that finally stops relying on cheap money as its default solution? That's not a question for economists alone. It's a question for everyone living inside this system. Because the next time that number moves on a quiet Wednesday afternoon, it won't just be about inflation. It will be testing how much strain the economy can still absorb and whether belief alone is enough to hold it together. If you want more breakdowns like this, calm, skeptical, and focused on how the system actually works, subscribe to the channel because the numbers matter, but the stories behind them matter more.